We live in a dynamic and volatile time, and so folks are looking for safe stocks. So they look at something like Coca Cola, KO stock. It yields nearly a 3% dividend yield, very stable growth, a company with an incredible brand and immense pricing power over time. So investors are wondering, is KO stock a potentially attractive investment from here? I'm going to share my thoughts on this potential safe stock. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Coca-Cola. So to understand Coca-Cola, first a quick background. They own and they market 5 of the top 6 non-alcoholic sparkling soft drink brands, including Coca-Cola, Sprite, Fanta, Diet Coke, and Coke Zero. But the reality is they own and market dozens of other brands, many of which you may not even realize are owned by Coke, or at least marketed by Coke. And when you understand their business operations, at least Coca-Cola stocks or KO stock, the vast majority of their business, their revenue, is actually tied to the concentrate. So selling the syrups that then go to their bottlers that actually sell the stuff. And they have bottling relationships around the world, depending on what region you're in. You know, if you're in Europe, Middle East, and Africa, you might be dealing with one of these various different bottlers. And oftentimes these are public companies. For example, Coca-Cola Hellenic Bottling Company. This is a company I was recently looking into because they sell into Russia. So their, business could get impacted. Another example is Latin America, where you're dealing with various different independent bottlers. And the advantage of having this type of structured relationship where you are selling the concentrate to these bottlers is that the amount of money that you have to invest, let's say in physical equipment for the bottling of goods and for the physical distribution, is actually a lot less. And so they are only investing around $1.4 billion a year in capital expenditures, but of that, only 0.1% is getting invested into capital expenditures tied to Latin America. Now, they do have about 40% plus going to their various different bottling investments, but that does give you some sort of picture of saying, oh, this is a capital efficient approach by having this structured relationship. And of the 5 largest bottling partners, the reality is it's an incredibly diverse group, because these 5 bottling partners, which are listed here, represent only 41% of their total worldwide unit case volume, which is really interesting. So as you look at Coca-Cola and try to figure out, okay, so where does their profitability come from? What does this business what actually does drive the business? So you can see in 2021, they had around $10 billion in operating profit. This was spread fairly evenly around the world. Their largest profitable segment was Europe, Middle East, and Africa, around $3.7 billion in operating profit. Then you see Latin America, North America, and Asia Pacific, all between, let's say 2.3 billion and 3.3 billion in additional profitability. But then you see, so this is sort of their global ops, but then they have these 2 other segments, much smaller: global ventures, bottling investments. Bottling investments, I'd say, is fairly self-explanatory, but global ventures is kind of interesting because it includes sort of these other bets. For example, their Costa Coffee bet that they have that, has a various different channels of reaching the customer. And their global ventures does include other things like a distribution agreement with Monster, as well as juice goods and teas. So this is really interesting that they are continuing to make other bets. And so as you consider the valuation, how should we think about Coca-Cola's valuation? And so, the first aspect that you need to think about is, well, what's their long-term growth look like if we're going to try to figure out what this valuation looks like? And so as you look at this, part of, I think, how management considers it is you look at a developed market where only 33% of the beverages are non-commercial, and that primarily means water. You look at a developing and emerging markets where closer to 70% are non-commercial. So over time, as there are more and more commercial beverages sold, Coca-Cola should ideally be able to keep some share or even grow their share. And so that is a secular tailwind that could drive their growth, in addition to acquiring new brands. And so that's why their long-term growth targets are organic revenue. So that means the secular tailwind of increased consumption around the world of 4 to 6%. They think with operational scale, pricing power, that really translates to 6 to 8% in terms of operating income. And then if you lever up with a little bit of either debt, or you use some of that profitability to buy back stock on the cheap, then your earnings per share is actually 7 to 9%. So this is really the figure, to be thinking about with shareholders. And then their free cash flow saying around 90 to 95% of that earnings, because they're going to be either retaining that 10% to reinvest it in their business or for, mergers and acquisitions. Another key aspect to think about their business that's going to be driving their sales over time is their pricing power and their ability to effectively pass on inflation. You can see how in developed markets they've moved from 12-ounce cans to mini cans, talking about how people actually kind of like it as it's less calories, it's more of a treat. But this system also results in a much higher gross profit. And you can see similar tricks around the world dealing with bigger bottle sizes, switching to smaller bottles, things like that ultimately give it a good vibe, but is a I'd argue a sneaky way of raising prices over time. And you can see that through their financials as well. Coke does a great job of sort of laying this all out, where they talked about in the fourth quarter how revenue performance included 10% growth in price and mix, i.e. they're able to pass through 10% higher prices, either through like the better bottles or just higher prices, but a decline of 1% in concentrate sales. So that is a good, point to think about, is you're going to have these two different drivers, impacting their business. Long-term concentrate sales should go up, but you also do have pricing power, and you do have this mix of, shifting around the bottle size and just raising prices each year. For the full year, what you saw, was around 17% growth year over year. Looking at 9% growth in concentrate sales and around 6% growth in price and mix. So that is, worth understanding and considering. And so as you look at their financials, the reality is Coca Cola, KO stock, is a cash flow machine with their operating profit in an incredibly tight range year on year. You could see in a period of COVID where sales decline unexpectedly, people are going to fewer restaurants, they're still able to manage a very tight range of profitability, ranging over the last 3 years from 26.7% to 27.2%. Really incredible. What a machine they have going. So then the question is, okay, so what are they doing with this profitability, this around $10 billion in profitability? So around $1.4 billion is getting reinvested in the business. So that's, fairly small when you think about it. The rest of it, and I'd say the majority, is going to dividends. And then you do have the occasional, acquisition. They acquired an 85% ownership interest in Body Armor. That was the remaining stake in Body Armor, a sports performance and hydration beverage, in November 2021 for $5.6 billion. This will be one-off based on, the opportunities that they see. The dividend should be fairly steady, and increasing over time. They talk about how it's increased the dividend each of the last 59 years. So this, this is a key point for a lot of investors, saying, hey, I'm getting around a 3% yield, a little under 3% yield. But one of the last outlets that they do have to invest is share repurchases. It is worth calling out that the company did not repurchase any shares under the existing share repurchase authorization. That in and of itself is a tell, because look, you do have, Warren Buffett is one of the major shareholders. He knows when the price is good. He would not want to see them buying back stock when it's too expensive or when the returns just aren't super attractive. And I'd argue when you see a company like this not buying back stock, that in and of itself is a signal to investors like, wait a second, this thing might be, on the fair value side, maybe even on the high value side. And let's talk about the exact, valuation as we think about this, the upside potential. So it is worth acknowledging that over the last decade, investors are paying up for Coca Cola stock. It's, it's varied over its, like last 100 years, but over the last decade, you could see how the price to sales multiple for Coca Cola has gone up from around 3.5 times sales to around 6 to 7 times sales now. So investors clearly are paying up for it. Part of it's because we're in a low interest rate environment and people say, hey, I want to own something that's stable and growing over time and that has that potential for growth. As I consider Coca Cola stock, it's just shy of $60 a share. While I do perceive it as, quote unquote, one of these safe and stable stocks from the perspective of a diversified business with stability, with pricing power, that incredible ability to keep their profit margins between 26 and 27%. The reality is that at, let's say, 30 times forward earnings and maybe 7 to 11% future growth rate, maybe, the return shareholders face isn't crazy compelling if you think there's a possibility that in the future you have maybe higher interest rates. If you get some sort of valuation compression in the years ahead, then I'd argue the return shareholders face isn't crazy compelling. Like if you say 5 years from now, the valuation is somewhere between 20 and 25 times, it's a lot less compelling. And while I think Coca-Cola's dividend yield is safe, just shy of 3%, if there's any valuation compression, then the total return for shareholders could be lousy. You're talking about, let's say, 35% price appreciation versus, let's say, a decline of around 15% over 5 years. So it's not crazy compelling, and that's part of the reason why this is arguably part of the reason why this investment environment is so challenging, is that you've seen, everyone sort of there is no alternative, the Tina aspect of this market, everyone sort of leaning in, okay, where can I get any sort of yield? And so everyone pushing up stocks like Coca-Cola, and that is sort of what makes this trickier as you consider this business. And so I look at Coca-Cola, and once again, laying out a framework for 7 to 11% annualized growth in the years ahead, looking at 2022, maybe 4 to 8% growth, that very steady 26 to 27.5% margins, 20% tax rate. So you could see, okay, penciling out somewhere between $8.5 billion and $9 billion in profitability this next year. Thinking about that, what's the end multiple, assuming some sort of multiple compression? If you think there's no multiple compression at all in the future, which I'd argue is a fairly aggressive assumption. I try to have conservative assumptions when I think about what's the upside that I'm playing for. But as I look at something like this, and I'm thinking, okay, we're currently, let's say, around 30 times forward. Could that come down in the future? And that is a core concern. And I'd rather be buying where, let's say, valuation could be a tailwind. Valuation could help me out as valuation expands over time. Here it is. I sort of look at valuation as a headwind potentially for investors. Now, keep in mind, this is a hypothetical framework. Of course, stock prices go way higher, way lower, than what I'm penciling out. A lot depends on management's execution and the underlying sentiment for the stock. If, sentiment goes crazy, the Federal Reserve says, hey, we're going to be, doing unlimited money printing, maybe this goes to 60 times earnings. So a lot depends on the environment and aspects like that. If you have a strong opinion on Coca-Cola stock, would absolutely love to hear it. And if you're interested in joining a community of investors looking for exceptional companies, looking to share their own personal journeys, I'd absolutely love for you to check out unrivaledinvesting.com, click join the journey. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.